Good evening, I'm Siddharth Zarabi and we are minutes away from key economic data, consumer price inflation and the index of industrial production. The CPI for July expected to come in closer to 6%, perhaps a tad and notch above it, while the IIP is expected to have grown perhaps 1.5% in June or even 2%. And joining me to discuss this, noted economist Saugata Bhattacharya, Senior Vice President at Axis Bank, as well as Sunil Sinha, Principal Economist and Director at India Ratings Research. Shogato, just a few minutes away from these two numbers, and the expectations really have been discussed significantly. The Reuters poll that we've been using and discussing. Okay, July CPI at 6.07, Shogato, that number has come in. The July CPI is at 6.07%. Your first comment on that number, Shogato?
More or less in line, Siddharth. We were at about 6%. So just a little bit above that, obviously coming in from food prices whenever we get those numbers. But I mean, justifies Reserve Bank's actions in holding rates. But remember, whatever the number, the print, I mean, this is this and next month.
I have to interrupt you. June IIP at 2.1%. The index for industrial production for June at 2.1%. Those two numbers right up there on your screen. The CPI for the month of July, 6.07%. In fact, above most expectations, and the same goes in for the IIP. Shogato?
Yes, completely right, Siddharth. I mean, both of them a little bit higher than expectations. So which is good. Again, I mean, we need to see the breakups of the IIP. The CPI is much more in line, and this is completely due to a base effect. So this month, the next month, August, September will be relatively high before it starts coming down. I don't know what the numbers for the capital goods are for the IIP numbers. We wait and watch. But again, I mean, it's more or less in line, little bit better than last month's number. So we live in hope that we are on the cusp of a slow, gradual climb out in economic recovery from this point.
Okay, Sunil, both numbers out. Any surprises there for you?
Not really. I mean, both of them are perfectly as per expectation. But yes, I mean, if I get into the minute details, then yes, I mean, the the CPI number is marginally higher than our expectation, and so is the IIP numbers. While one is certainly a welcome sign that we were expecting a 1.3% growth in IIP, it has turned out to be 2.1, so I'm happy about it. But on the other hand, we were expecting the WPI to hover somewhere around 5.83%, but it has actually come out to be a little above 6%. So both good and bad. But on the whole, if one looks at the trend, then these were kind of expected trend. And both the numbers have followed the trend.
The food price numbers that we are getting clearly shows that as far as food price inflation is concerned, 8.35% versus 7.7% on a sequential basis, continuing to harden, and obviously the impact of the monsoons will perhaps pan out, but for now, casting a long shadow, Shogato, on the fact that we are perhaps not going to meet the target as envisaged by March 2017?
I think you are completely right, Siddharth. There is a very strong possibility, given the trajectory that we see moving forward over the rest of the year, that we will end up FY17 at March 2017. We will end up about 5.4 or thereabouts, unless we get a very sharp retracement in food prices, other prices, once the rains, once the sowing, of the harvesting of the crops come in, we are likely to cross the RBI's trend, the projection, the forecast of 5% for March 17. But having said this, from whatever we understand, there are many pressures now in terms of the GST, in terms of the seventh pay commission, a little hardening of oil prices, commodity prices, that over the course of the next year, we are probably not likely to get much below 5%. In fact, we probably will stay above 5% for the rest of FY18.
So clearly, if you look at the breakup of the data that we are now getting, the July index provisionally for several items like food and beverages up at 137.6, pan, tobacco, intoxicants 138, clothing and footwear again marginally higher than the trading data. Fuel and light in the same sort of range. The overall general index of all groups slightly higher, and that's what has sort of led to the CPI. You know, the point I want to ask you, and before we do that, just some of the numbers that we are now getting for the IIP. The general index obviously 2.1% higher as compared to June 2015, and what we are seeing is that mining, manufacturing and electricity for the month of June 2016 at the index number of 127.3, 191.3 as well as 198.9, corresponding to 2.7%, 0.9% and 8.3% as compared to June 2015. Before I go into some of the other item-wise classifications and the fact that some important items continue to show high negative growth, my question to you, Shogoto, if I can come back to you, is anyone really looking at this IIP number anymore?
Yes, I mean completely. I mean, you know, the next series of IIP based on the 12-13 index is likely to come out in November, December. So remember that we used to, you know, express concerns about the GDP, GVA numbers relative to the IIP, but now we need to seriously look at the reality of the IIP numbers themselves. How much, in particular, the capital goods numbers, how much they are likely to be reflecting actual reality is something that we need to understand. Although, to be fair, I mean, you know, trying to match the IIP numbers with the preliminary estimates of the quarter one, the financial results that we have seen, it does seem to indicate that volume growth in Q1 has been relatively modest. But if you were to deflate that with the WPI numbers, that would tend to indicate that that's where the profit growth numbers that we are seeing has come out. So there is some broad convergence, but otherwise, in terms of the finer details, I don't know.
Sunil, the point is that we've seen capital goods for being in continuous decline, 2 quarters plus, which indicates that headwinds as far as the capex cycle is concerned continue. What we have seen is an uptick in consumer durables, the urban consumption story, auto, home loans. The broad consensus, if I may put it that way, is that this uneven, patchy recovery so far has been an uneven and patchy recovery. With this latest data, do you think that is changing and the uneven, patchy recovery is perhaps headed towards a more stable growth momentum in some of the underlying sectors that the IIP captures?
Look, two things. So far as consumer durable goods are concerned, particularly when we look around the CM data and for few other items, certainly there seems to be some hope. However, when one looks at the overall capital goods data, then as you rightly pointed out, the sustained negative growth is a cause of concern. Now let me point out two things. In fact, if you go and read the RBI commentary of last year, then in one of the bi-monthly review, RBI has clearly stated that whatever recovery the last fiscal had witnessed in case of capital goods, or the capital goods were consistently showing a positive rate of growth, that was largely due to some of the projects which were stalled had suddenly started moving. So most of the demand for capital goods was not coming from the greenfield projects or the new announcement. It was mainly because of the stalled projects. So to that extent, that demand was not something which was sustainable in the long run. So as and when that demand petered out, once again the capital goods sector has started witnessing the negative growth. The other point that I want to make about the manufacturing sector is that even in the latest survey which RBI had put out, the overall capacity utilization is 72.4%. So there is still excess capacity in the manufacturing sector. So let's not forget that so long as that kind of excess capacity remains in the system.
I just wanted to bring up the sectoral points, sectoral numbers, what is playing out on our screens. In mining, you are seeing 4.7 versus annualized negative 0.4. Manufacturing, again 0.9 versus 5.2. Electricity 8.3% versus 1.2 for the year before same period, and therefore the general index it's almost like a flip of what it was, 4.2% versus 2.1 now. Shogato, I want to come to you out of this on this very point. When we were talking these numbers, the main numbers, we saw unexpected rise and a number reading at 1.2. Now you see 2%, and it's clear now what seems to have led to that. Given that we will see some amount of the government spending, the government allocation, some of the, for instance, in the road sector and railways, for instance, and a couple of other sectors, that spending getting translated into perhaps execution on the ground. Is this growth momentum going to continue, or will we see another flip-flop a couple of months down the line?
Siddharth, very important points. I mean, coming in from the government spending, remember that the Reserve Bank in its latest monetary policy statement actually explicitly mentions this, that this up-down movement, I mean the sawtooth movement in the IIP is being caused predominantly by the very volatile capital goods segment. Now, this is something that we need to point out, that there is this flaw in this IIP, the earlier point that you raised, the specific point, that this is getting distorted, the capital goods numbers is getting distorted by one particular industry which you would have noticed, rubber cables, insulated rubber cables. Now these are used by telecom companies, and there is a wild swing, minus 92%, minus 68%, plus 35% and so on. It's not very large. But what is happening is that this is now represented by a very small number of companies, and this is a major cause of distortion. Now, if you exclude this particular segment from the IIP growth, rather than a minus 3% growth that we see in FY17, the first 2 or 3 months, you're actually getting a positive 8% growth in capital goods, which ties in completely with what you just mentioned in terms of the government spending a lot on power transmission, on roads, on railways, on urban transport, urban infrastructure. And our sense is that we are actually beginning to see a curve upwards on this. That if we exclude some of these distortions, which is exactly what you mentioned, that till the new IIP comes in, there is nothing that you can do about this. You just trust your instincts on what is going on. Secondly, I think the where we all went wrong, that our 1%, 0.5% predictions of the IIP is, I see coming in essentially from the consumer durable segment. That has shown a very strong 6% growth, if I'm not mistaken. So that we need to understand where that thing is coming in from. So whether it's gems and jewelry, which to our mind remain very weak because we know the car numbers and so on. So that's something that we need to understand, where the consumer goods number has come in so strongly from.
Gems and jewelry doesn't seem to have done it, and you raised a very interesting point. I don't know whether I should call it the geo effect or not, but let me go to Sunil. One more point on IIP before we go back to something that concerns every Indian, in the 70th year of independent India. Sunil, this uneven growth recovery is a fact, and all of you have factored it in. All economic players, stakeholders have factored it in. One of the elements that we all know has panned out is the support that we have got from low crude oil prices. But there is now this sense that crude is not going to remain low forever, at least not at the levels that we saw, whether you take the previous quarter or whether you take the last 6 months, depending on whichever way you look at it, it is going to not remain low forever. Therefore, the same point that I asked Shogato, but in a different manner, do you see a sustained sort of uptick despite the blips like telecom cables or some other monthly seasonality or data capture anomaly?
Well, I mean, Siddharth, the point is that how the oil prices will behave over the next year, 2 year, 3 year is pretty difficult. But at the moment, the expectation is that it is unlikely to harden to a very, very high level, whereby it will really start hitting the economy across the board. So that kind of a situation is still not there. So at least for 1.5 years is what our expectation is. So under that scenario, I mean, I do not see, the pressure on the corporate sector performance is really emerging from the rise in the oil prices. On the contrary, my biggest worry is still with respect to the investment revival, the capital goods sector, the corporate investment, which is still somewhere not picking up. I mean, despite the fact that government has stepped up its capex. But let's look at the data. I mean, states are even a bigger spender so far as capex is concerned, in India as compared to the union government. But if you put together the capex spending of both center plus state, then that still constitutes just about 16% of the total capex investment in the country. So, I mean, the revival of the capex cycle is not going to be determined by what either the state government or the union government does. To some extent, it will certainly provide the fillip, but rest of the animal spirit has to come from the private corporate sector. And so long as that does not happen, my worry is that we will continue to witness these kind of flip-flop so far as industrial growth is concerned. I mean, notwithstanding the fact that there are problems with the current IIP.
Very good points there, because we should not forget that the IIP is a lead indicator used as a core ingredient of national accounts, but it's the universe is not the same as GDP. And what we are seeing is signs on the same road. But the point that you mentioned about animal spirits, well, if you continue to look at what has been said as forecasts, for instance, by some of the companies who influence this over this earnings season, and if you also look at the current debt levels, I don't think there is hope on that account, at least in the immediate near term. But let's quickly turn our attention to inflation and the point I want to now bring up, along with some of the numbers that are running on the screen, the last 3-4 months we have seen inflation being above forecasts. The last time, a couple of months back, before the start of the monsoon season, there was a bit of a divergence in opinion as to what impact the monsoon would have and what would be the kharif crop sowing. The monsoon is behind us, more or less, Shogato, Sunil, at least in terms of the fact that a large part of the country has been covered, or a large part of the monsoon season, the traditional monsoon season, has also petered out. The food price inflation, that sticky bit, is there expectation that before the next sort of consumption boom around the festival season, you would see a sustained downturn. And with some of the systemic administrative measures that some states have taken, could that translate into a more sustained decline as far as food price inflation is concerned? And I'm not just referring to pulses here. Shogato, I want to come to you first on that.
So, I mean, this is a hope. I'm not very sure. I mean, looking at the IIP numbers, sugar output is significantly down, and which is exactly what is leading to the spike in sugar prices. There are spikes in a couple of dal varieties, pulses, so that still hasn't come down, and I'm not very sure how fast that can come down. As you mentioned, I mean, July rains have been pretty good, but that doesn't seem to have affected vegetables prices very significantly, although I'm sure it's come down marginally. So that doesn't seem to have affected. We still hope that vegetable prices will stabilize down the road. Casual channel checks seem to indicate that most vegetable prices are finally beginning to come down in Mumbai, at least. That where we live, and so but I mean, remember that the projected trajectory that we were talking about before actually factors in a large part of these declines in food and vegetables prices. So it actually factors in the effect of the good rains. So that, with that caveat, I mean, I hope that we can get down to a 4.5 to 5% range for the next 4-5 months. But exactly as you mentioned, there are other structural factors. First, the festival spending, then the effects of the 7th Pay Commission payouts that we are seeing next month. I'm not very sure whether we are seeing a sustained fall either in vegetables and food prices or in the overall the CPI complex.
On a complete aside note, you know, I don't know if both of you gentlemen track mango prices and consume them on a sustained basis. I can tell you that mangoes, unlike last year, have been on an average cheaper, including the East UP varieties and the first that really hits us in the market, the Alfonso, that wasn't there, but some later on some of the other varieties have seen a decline. But that was not my question. Sunil, I wanted to pick up this point that Shogato said. He mentioned 4 to 5 months. Will it be correct, therefore, or what is your own call, that the effect of a good monsoon minus all the other imponderables is going to translate into lower food price inflation by the last quarter of at least the current calendar year? Is that a fair assumption? Would you agree with that?
Look, Siddharth, you know, I mean, if that happens, I'll be more than happy. But here I am a little less optimistic than Shogato, because my reading has been that inflation has time and again surprised us on the upside, and it has actually come from a number of times from unexpected quarters. For example, if you look at the seasonality and study the seasonality pattern, then I don't see why the vegetable prices at this point of time should be so high. I mean, when the rains are okay, and you know, in general there is you know, a cheer about
on that point, Sunil, can I stop you on that point to ask a specific question?
Yeah, sure.
To ask you a specific question, I'm cutting you off. You know, this may be a completely wrong question to ask, but isn't there also a fact that more and more consumption is happening as there is more you know, paying power, purchasing power? I noticed in the market that you know, I don't know how to say this, that more and more people are buying more and more quantity of the same product, where in the food and vegetable space, where acreage has not significantly grown up, it is not done on an industrial scale, and therefore as there are more buyers, perhaps chasing this chimera of sustainable food prices or sustainable food price inflation is wrong, because more and more of India is consuming more and more of fruits and vegetables, more and more of proteins. So and this becomes such a huge indicator for economy. It will become a huge indicator or a weight over the next RBI governor, the next or the new MPC.
Exactly. I mean, Siddharth, I was actually coming to this very point, that I think in terms of reading the food inflation, I mean, we have been shifting the goalpost time and again. Sometimes we say it is sugar, sometimes we say it is milk, sometimes we say that it is protein rich items, sometimes we say it is vegetables, sometimes it is fruits, sometimes it is onion. So the point that I'm still worried about is that I think there is a structural shift so far as demand for certain types of food items are concerned, and we have still not developed a full understanding of exactly what is going on, where the problem is on the administrative side, whether the problem is really with respect to the supply chain, which of course is there, but nevertheless, I mean, with all the administrative measures taken now, I mean, someone would have hoped that it would have some softening impact on the overall prices. But nothing seems to be working. I mean, we are getting surprised time and again with one odd commodity really, shooting through the roof. So the basic point is that so far as we really do not develop a full understanding of the food inflation. I mean, I'm not talking about the cereals part. I'm talking about the non-cereals part, particularly the food, the fruits, yes, vegetables, milk, non-veg items, protein-rich items. I don't think we will be able to get a handle on inflation. I mean, that's
Shogoto, last point to you as we. Good points there, Shogoto. The last question to you, the same point really, before we wind down this show and wish our viewers a very happy 70th Independence Day. On the issue of inflation, the government, the RBI willy-nilly have bound themselves to food price inflation in the belief that it is a politically sensitive item. Just a couple of hours back, I was speaking to someone who sort of supplies food in the area where we work out of in Delhi, and he said sabziyan bahut महंगी आ रही हैं sir. And my next question was, बारिश के कारण कोई फायदा? बोला नहीं, पीछे से माल नहीं आ रहा है. So which is what Sunil also said, and that brings that the last question to you again. This is going to keep happening, and this has happened over the last decade after the 2004 increase, that cycle that we saw. Would a policy, a fresh look at policy be required now that you will have a new RBI governor perhaps within a few days and a new policy committee to set rates within a few weeks? Right.
I think Sunil makes excellent points on this, that the supply chain somehow or the other needs to be improved. Exactly as you said, that the government has bound itself to an overall 4% target, and given the stickiness of the non-services inflation, you have to bring down food prices in some way or the other. But I mean, let me point out the issue of sugar prices, which is contributing to this, to the residual high inflation. Sugar prices, I mean, we are trying to ban futures in futures trading in sugar. That's probably not the correct way of trying to measure, trying to reduce sugar price inflation. I mean, we have had 2 years of drought, as a result of which there are shortages. You've seen the sugar production in the IIP. So, but I mean, futures markets are essentially one way of trying to smoothen prices over a period of time. So that's one illustrative example of the range of mechanisms that we have to use, the use of genetically modified crops, the use of logistics, the use of markets together. I mean, unless we work on this as a comprehensive package, we have already started working on the water aspect, the irrigation aspect. So unless we do this, as like Sunil and probably you, I am also not very, very hopeful that we'll be able to sustainably bring food inflation down.
Well, that's a good point to make, Shogoto, towards at the end of this show, because if nothing else, all of India can live on hope that prices will be contained and that interest rates will be low, and that we will really have Achhe Din around the corner. Saugata Bhattacharya, Sunil Kumar Sinha, thank you very much for your time.
Thank you, Siddharth.
Wishing you a very happy Independence Day, and the same to our viewers. We'll keep coming back with more. Don't go away.